Good day everyone, I am Christine, the moderator for this webinar. I welcome everyone to today's webinar, Estate Tax Reporting Forms 1041 and 706. I want to introduce our presenter for today, Jason Dinisan. Jason Dinisan, EA, LBA, is a tax nerd, entrepreneur, tax expert, and a well-known continuing education course presenter. Jason was born and raised in Iowa and has a degree in corporate communications from Simpson College in Indianola. I would now like to hand over the floor to the speaker. Over to you, Jason.
So this is all about estate tax. Form 1041 is estate and trust income tax return. And then you have the actual estate tax, which is something different. That's Form 706. So Form 1041 is income. It's income tax based on income received by the estate or trust. It's a year-to-year filing if the estate or trust has income in that year, just like it is with individual income taxes. So let's talk about Form 1041. These are the types of entities that might file Form 1041. So due dates of the Form 1041, April 15th, or technically the 15th day of the fourth month after the end of the year. And then there's late filing penalties, just like there are for any other entity or individual with the same basic rules. Some other things, definitional sorts of things to be aware of. This is estate income tax. It could be a decedent's estate, a deceased person who receives income after the date of death, or it could be any of these other types of trusts or estates. Distributable net income. Distributable net income can be quite easy. If it's a type of estate or trust on the 1041 that's passing everything out to the beneficiaries. You also have income required to be distributed currently. That just means that when the income is received, it's to be paid out generally in that same year. There's not a whole lot to say on this slide because a lot of what we talk about is kind of the more basic stuff that I think most of us will see in day-to-day practice. Not going to linger on this too much, although we do talk more about like remainderment. What is that? So what is a trust? It is an arrangement created either by a will or what's called inter vivos, which means during life. We don't really get into grantor, non-grantor, and intentionally defective grantor trusts. All right, so we have simple and complex trusts. So here we're looking at the 1041, the income section. You have deductions. There's certain things that might be allowed as deductions or credits that could be claimed on the 1041 that might not be allowed on the decedent's final return. You know, most 1041s that you're going to deal with in the real world pass everything out to the beneficiaries. So I highlighted the exemption line a couple of slides ago and talked about how on the 1041 there's an exemption deduction, which is basically a standard deduction. It's why most of the time trusts and estates pass everything they possibly can out to the beneficiaries. Unless it's a bankruptcy estate, bankruptcy estates have a far more generous rate schedule, telling you that the 1041 is also subject to alternative minimum tax. These entities want to pass everything out to beneficiaries if possible. Cannot be voluntary. All right, distributable net income. Schedule B is where you account for the deduction for things passing out to the beneficiaries. This we have some examples on upcoming slides because some of this gets a little. This is a formula. I think it's something we can look at for reference. We have an example. Income in respect of a decedent is where we turn next. This is something you could see. So some types of income in respect of a decedent, deferred salary payments, anything earned by the person through their date of death. But here's how deceased employee wages are supposed to work. This is another one where looking at an example is probably more helpful than all of those words. There'll be inconsistencies sometimes on reporting because sometimes, especially on like investment accounts and stuff, they may not know right away that a person passed away. So Form 1041 and 706, we're kind of resetting our minds here because we're going into a transition to the 706 now. Form 1041 can generate a net operating loss because rules for NOLs are the same as for individuals. All right, now we move on to Form 706. We touched on this earlier. When someone passes away, they have an estate. Whether you know it or not, they do in fact have an estate, which is everything that they owned at the time of their death. Unified concept. The annual gift exclusion for 2023 was $17,000. It's $18,000 for 2024. But first, let's talk about the forms. Form 706 is the form that you must file within 9 months of the date of death. Non-resident alien. We can move past this. You can see, though, what the rates are. Starts at 18% and goes up. So here's the interplay between gift tax and estate tax. Spousal portability, technically called the deceased spousal unused exclusion. Inherited property, no matter who it is that inherits the property. A spouse, a child, a best friend, a neighbor, whatever, gets what's called a stepped-up basis, which means that the beneficiary's basis is equal to whatever the fair market value of the property was at the time of death. Just real quickly on non-resident aliens, there's a lot of words here. Property owned by a non-resident alien cannot be distributed to beneficiaries, and looking at the Form 706, let's move to the next slide here. Recapitulation is what the Form 706 calls it. Executor. So executor means like the personal representative or administrator of the estate. They are the ones who will file the Form 706 and sign it. So gross estate includes all property in which the deceased person had an interest, including things owned outside the United States if they have a house in another country. Life insurance in the deceased person's name. This is another thing that gets tricky to wrap your mind around. Let's go to the next slide here. The executor can elect to value all of the property on the alternate date, funeral expenses and administrative expenses. I wanted to talk about retirement account. So again, this gets back to the concept of income tax versus estate tax. Gift tax. And we touched on this. If someone gives a gift above whatever the thresholds are, $17,000 in 2023, $18,000 in 2024, $19,000 in 2025, they might need to file a gift tax return. Gifts to a spouse are unlimited if it's of a present interest. Most of the time it will be gift of a present interest. And that's what this example is saying. Well, that brings us to the end. Okay, well, thanks so much for joining us. Thanks so much and have a great day.
Okay, that concludes the session for today. Thank you everyone for participating. You may all disconnect now and have a great day.